Traditional saving methods are often promoted as secure approaches for personal finance management. These methods typically involve depositing funds into bank accounts or similar low-risk instruments. The perceived security stems from their stability and protection against market volatility. However, their effectiveness in the current economic climate requires critical evaluation. Factors like inflation and low interest rates may diminish the real value of these savings over time. The conventional wisdom suggests that saving money is always a beneficial financial strategy. However, a fundamental economic question arises regarding the long-term efficacy of this approach. Is saving money invariably the optimal strategy for enhancing financial well-being? Or can an excessive focus on saving paradoxically lead to a decline in financial health over time? This concept explores how inflation and opportunity cost can erode the value of static savings. It prompts a reevaluation of financial strategies beyond mere accumulation towards growth and investment. Inflation is an economic mechanism that silently erodes wealth over time. It systematically reduces the purchasing power of money. This reduction in value occurs over extended periods. Consequently, goods and services become more expensive. The same amount of money buys fewer items than before. Funds deposited into a low-interest savings account earn minimal return. Inflation, the general increase in prices, erodes purchasing power over time. Even if the nominal balance remains constant, the real value of savings decreases. This phenomenon highlights the hidden cost of holding cash in low-yield accounts. Purchasing power refers to the quantity of goods and services that a unit of currency can buy. Over time, the purchasing power of money can decrease due to various economic factors. This phenomenon is commonly known as the erosion of purchasing power. It means that a fixed nominal amount of money loses its value progressively. Consequently, the same amount of money will acquire fewer goods and services in the future. This erosion has significant implications for savings, investments, and overall economic stability. Inflation refers to the rate at which the general level of prices for goods and services is rising. Consequently, the purchasing power of currency is falling, meaning less can be bought with the same amount. For example, if one saves $10,000 with an annual inflation rate of 2%, the money retains its face value, but its actual buying capacity decreases over time. After 1 year, the $10,000 would effectively have the purchasing power of $9,800 due to inflation. Investment opportunity cost refers to the potential returns missed by not pursuing an alternative investment. It is a critical concept in financial decision-making, highlighting the value of foregone option. The decision to not invest in available opportunities carries significant financial implications. Foregoing investment means relinquishing the potential for substantial financial growth over time. This inaction can impede long-term wealth expansion and the achievement of financial goals. Understanding opportunity cost is vital for maximizing returns and optimizing investment strategies. When money is not invested, it loses the opportunity to generate return. This phenomenon is known as missed growth or opportunity cost. Over an extended period, this can lead to a substantial shortfall in accumulated wealth. Therefore, timely investment is crucial for maximizing financial growth. An initial investment of $10,000 serves as the principal amount. This sum is placed into a diversified investment portfolio. The portfolio is projected to yield an average annual return of 5%. Over a decade, the initial $10,000 would grow to approximately $16,288. The compounding effect significantly impacts financial outcomes over time. This effect arises from the combined influence of inflation. It also includes the impact of lost investment opportunities. Inflation erodes the purchasing power of money over time. Lost investment opportunities represent foregone returns on capital. Together, these factors intensify, creating a magnified negative financial impact. Saving funds without investing them carries significant financial implications over time. The primary consequence is the loss of potential financial gains that could have been earned through investment. This missed opportunity is often referred to as the opportunity cost of not investing. Over extended periods, this can lead to a substantial reduction in overall wealth accumulation. Therefore, the longer funds remain uninvested, the greater the potential for diminished financial growth. The primary objective of financial management extends beyond merely achieving positive returns on investments. A crucial goal is to ensure that the rate of monetary growth at least matches the prevailing inflation rate. Ideally, the growth rate of money should surpass the inflation rate to maintain purchasing power. Inflation erodes the value of money over time, reducing its purchasing power. Therefore, Effective financial strategies aim to make money work efficiently by outpacing inflation. Excessive saving without concurrent investment can lead to financial stagnation. This occurs when deposited funds fail to grow sufficiently over time. The growth rate of savings does not keep pace with rising living costs. Consequently, the real value and purchasing power of the savings diminish. This scenario highlights the importance of balancing saving with strategic investment. Financial paralysis describes a state where individuals become unable to make financial decisions. This condition is characterized by a reluctance to spend money, even on necessary items or experiences. Crucially, it also involves a failure to actively invest or expand one's wealth. Individuals in this state often hoard assets without putting them to productive use. The outcome is a static financial position, where wealth neither grows nor diminishes significantly. This can hinder long-term financial goals and overall economic well-being. Inflation erodes purchasing power, diminishing the real value of savings over time. To counteract this, investors seek inflation-beating assets designed to grow faster than inflation. Equities or stocks have historically provided returns that outpace inflation. Real estate, another key asset class, often appreciates in value, offering a hedge against rising costs. Investing in such assets helps protect wealth from financial stagnation caused by inflation. Saving without investing is a distinct financial strategy under specific circumstances. This approach is appropriate when immediate liquidity and capital preservation are paramount. A primary example is the establishment of an emergency fund. Emergency funds are designed to cover unforeseen expenses, such as medical emergencies or job loss. The goal is to have readily accessible cash, not to generate returns through investment. This strategy prioritizes security and accessibility over potential growth. Long-term wealth creation is a key financial objective for many individuals. Achieving this goal requires a strategic approach to financial management. A balanced strategy is typically more effective than focusing on a single method. This balanced strategy incorporates two primary components: saving and investing. Saving involves setting aside money for future use, often in low-risk account. Investing involves deploying capital into assets with the expectation of generating returns over time. A balanced investment approach is crucial for financial stability and growth. Diversifying investments is a key strategy to mitigate overall risk exposure. This involves spreading investments across various asset classes and sectors. Selecting assets must align with an individual's specific financial objectives. Investment choices should also be congruent with one's personal risk tolerance. This comprehensive strategy aims to optimize returns while managing potential losses effectively. True wealth accumulation is rooted in fundamental financial principles. It emphasizes strategic investment as a primary driver of growth. This approach necessitates the acceptance of calculated risks, not avoidance. It contrasts with merely accumulating cash reserves, which often lose value over time. Opportunity cost is an economic concept representing the value of the next best alternative. It arises when a choice is made, foregoing potential benefits from other options. For individuals, excessive saving without investment incurs an opportunity cost. This cost is the potential earnings or growth that could have been realized through investment. Thus, opportunity cost quantifies the unearned benefits from a foregone alternative. Prudent financial management is a strategic approach to handling monetary resources. It emphasizes careful decision-making rather than impulsive or excessive spending. This principle applies to both personal finances and organizational budgeting. It involves a deliberate and thoughtful allocation of financial assets. The goal is to optimize resource utilization for long-term stability and growth. Prudence ensures financial health through responsible planning and execution. Achieving significant financial goals often requires more than just saving money. Strategic investment is a critical tool for reaching these objectives. It provides the necessary growth that mere savings cannot offer. Investments can generate returns, compounding wealth over time. This approach helps bridge the gap between current resources and future financial aspirations. Retirement planning involves strategic financial decisions to secure post-employment living standards. A key component is investing in a diversified portfolio, spreading risk across various assets. This diversification is crucial for generating the necessary growth in retirement savings. Such growth aims to sustain a desired lifestyle and cover expenses after employment ends. Saving and investing are often perceived as distinct financial activities. However, their relationship is not mutually exclusive. They are complementary strategies. Saving involves setting aside money for future use, often for short-term goals or emergencies. Investing involves allocating saved funds into assets with the expectation of generating return. Together, they form a robust approach to financial growth and security, working in conjunction. Building wealth requires a strategic approach that goes beyond mere accumulation. A judicious balance between saving and wise investing is indispensable for financial growth. Saving alone, without investment, can lead to a phenomenon known as saving your way to poverty. Therefore, integrating both saving and
Invest wisely to protect your wealth from inflation's impact.